Ever get that deer in the headlights feeling? Yeah.
Yeah, me too. Every time I see mortgage rates, it's like everyone's suddenly speaking this secret financial language, like I missed the memo or something.
I know what you mean.
But the thing is, we need to learn this language right, because even a tiny difference in those percentage points
Absolutely.
can mean thousands of dollars saved over the life of your loan.
Huge difference.
So we're talking serious money here, and that's what we're diving into today. Like, how do we even decode these mortgage rates?
Yeah.
And more importantly, I think, how do we make them work for us?
Well, I think what's so interesting about mortgage rates, it's easy to feel like they're just these random numbers,
Yeah.
But they actually represent the cost of borrowing a significant amount of money. We could be talking hundreds of thousands of dollars, right, to buy a home.
It's a lot.
So think of it like renting money.
Right. The interest rate is basically your rent payment to the lender.
Yeah.
So lower the rate, lower your monthly payment, and that obviously saves you a ton of money over the long haul.
And we're talking decades long.
Exactly. This is a big commitment. It's not just, buying something on Amazon.
No, not at all.
No. There are big economic things that influence these rates, of course.
Right.
Things like what's happening with inflation or decisions made by the Federal Reserve, things that can feel totally out of our control.
Yeah, it feels like trying to control the tides, almost.
Exactly.
So no use stressing over that stuff too much. But that doesn't mean we're totally powerless when it comes to getting a good rate.
No, not at all.
Right.
You have a lot more influence than you might think. By understanding what lenders are looking for and making strategic decisions, you can really put yourself in a great position to get a really good rate.
Okay, so that's kind of empowering, right?
Yes, and that's where it gets really interesting, because there are things you can actually do today, like concrete actions, to make yourself a more attractive borrower.
Okay, so let's break it down. What are like the biggest levers that we can actually pull to like impress these lenders?
Well, one of the first things lenders look at is your credit score.
Of course.
It's kind of like your financial report card.
Oh, okay.
It revealed your credit worthiness.
Okay. So time to channel our inner like straight A student,
Exactly.
ace this credit score thing. But how do we even start to improve that?
It all starts with awareness. So you want to check your credit report regularly, and you can actually get a free report from each of the 3 major credit bureaus annually. You can do that through annualcreditreport.com.
Okay.
And this lets you see if there are any inaccuracies. Like, believe me, even small errors can really impact your score.
Really?
Yeah, so correcting those errors, it's like free points.
Makes sense. You don't want some like little typo tanking your whole financial grade.
Yeah.
So credit score check. What other factors are lenders like analyzing when they're, sizing us up?
Another big one is your debt-to-income ratio, or DTI. It sounds kind of complicated, but it's actually pretty simple.
Okay.
It's basically how much of your monthly income is already going toward paying off existing debts.
Okay.
So that's things like your credit card bills, student loans, car payments, that kind of thing.
So the less debt you have compared to like how much you're bringing in every month, the more financially stable you appear.
Exactly.
Okay.
Lenders want to be sure that you can actually manage a new mortgage payment on top of your existing financial obligations. So if you're really serious about getting a lower rate, paying down some debt can be super helpful. Even just exploring ways to maybe boost your income a bit, maybe a side hustle or negotiating a raise, that kind of thing can really improve your DTI and just strengthen your application overall.
Yeah, I like the way you think. A little side hustle never hurt anyone. Okay, so we're building a solid foundation here.
Yeah.
Good credit, healthy DTI. Anything else we can do to kind of tip the scales in our favor, signal to the lender that, hey, we're serious about this whole home buying thing?
Yes. Having good cash reserves can make a big difference too.
Okay.
Think of it like your financial safety net.
So it's not just about saving for that down payment. They want to see we've got our act together overall, basically.
Yeah, exactly. So those cash reserves, they show the lender that you're prepared if any unexpected expenses come up, right? And that just makes you less risky in their eyes. It shows you're financially responsible. And it can even sometimes help you get a better rate, even if your credit score and DTI are already good.
All right, so we've laid the groundwork, right? We're talking good credit, a healthy DTI, a nice cushion of cash reserves. Check, check, check.
It's a great start.
But now let's get into the mortgages themselves, because I'll be honest, I've always felt a little overwhelmed by all the different options out there. Is it really as simple as like, just go for the 30-year fixed rate and call it a day.
Well, you're right. It can feel overwhelming. And while that 30-year fixed rate mortgage is super common, there are actually a bunch of different types of mortgages out there, and they each have their own quirks and potential advantages. It's like, choose your own adventure, but for home loans.
Yeah.
And the path you pick, it can seriously impact your interest rate and just your overall costs.
Okay, so tell me more about these mortgage options. What else is out there besides the standard 30-year fixed rate?
Well, you've got things like FHA loans. Those are insured by the Federal Housing Administration.
Okay.
And those are really good for first-time home buyers or maybe people with lower credit scores because they tend to have a little bit more lenient requirements.
Got it.
Then you've got VA loans, which are specifically for veterans and active military.
Right.
And those offer just incredibly competitive terms and benefits.
Wow.
And then there are also USDA loans. Those are designed to help people in rural areas.
Okay.
And those can be amazing options, often coming with lower interest rates or even down payment assistance.
Oh.
I sense a but coming. There's always a catch, right? Right. It's really important to remember that while these government-backed loans might have lower interest rates, they often have added costs too.
Okay.
Things like mortgage insurance premiums.
Right.
Which basically protect the lender if, you happen to default on the loan.
Right.
So it's not just about the rate, it's about understanding what's the total cost of this loan going to be over time.
It's like those too good to be true deals. Gotta read the fine print. What about those adjustable rate mortgages? Are those ever a good idea?
They can be. It really depends on your situation, your risk tolerance.
Okay.
So with an adjustable rate mortgage or ARM, your interest rate is fixed for a certain amount of time, maybe 5 or 7 years.
Okay.
And then after that, it can adjust, go up or down based on what's happening in the market. So these can be appealing if you think your income is going to go up a lot in the future, or if you plan to move before that fixed rate period ends.
So it's potentially higher risk, but potentially higher reward.
Yeah, exactly. And here's another crucial piece of advice. Don't just go with the first lender you talk to. Shop around.
Okay.
Just like you wouldn't buy a car from the first dealership without comparing prices, don't settle for the first mortgage offer you get either.
That makes sense. But I have to admit, the thought of contacting a bunch of different lenders sounds kind of intimidating. Is it really worth the extra effort?
It absolutely is.
Yeah.
Because different lenders have different criteria.
Right.
What might be a deal breaker for one might be totally fine for another.
Oh, okay.
Plus, that competition can work in your favor. There was a study by Freddie Mac, actually. Borrowers who got quotes from at least 4 lenders saved, on average, $600 to $1,200 per year.
Wow.
That's significant.
That's a lot of money.
Yeah. That could be going towards your principal, other financial goals, even a nice vacation.
Okay, you've convinced me. Shopping around it is. So let's say we've explored our options, right? We've shopped around, compared offers, found a mortgage we like. Are we home free at that point?
Almost. Now comes the exciting part, making some strategic decisions about your loan terms to try to snag an even lower rate. One of those decisions is whether or not you want to lock in your interest rate.
Okay, a rate lock. It sounds kind of intense.
It's actually pretty straightforward.
Yeah.
When you lock your rate, the lender's saying, okay, this is the interest rate. We're guaranteeing it won't change between now and when you close on the loan, even if the market rates decide to do a roller coaster.
So it's like insurance, but for your mortgage rate.
Exactly. It gives you that peace of mind knowing that your rate is safe and sound, especially when the market's being unpredictable. But of course, there's a trade-off. If rates go down after you've locked yours in, you could miss out on some savings.
It's like a gamble. How do you know when's the right time to lock in?
That's the million-dollar question. It really comes down to how much risk you're comfortable with, what the market trends are looking like, and getting advice from the experts.
Right.
Your lender, a financial advisor, they can be great resources during this time, helping you weigh the pros and cons for your specific situation.
So communication is key. Don't be afraid to lean on those experts. You mentioned strategic decisions. What other choices can we make during this process that might influence our rate?
The amount you decide to put down for your down payment, that plays a big role.
Okay.
You probably already know that a bigger down payment means you're borrowing less money overall, which usually means a lower monthly payment too.
Right.
But did you know it can also directly impact the interest rate you're offered?
Wait, really? I thought that was mostly determined by my credit worthiness.
Your credit history is super important for sure, but a larger down payment actually lowers your loan to value ratio, or LTV.
Okay, pause. LTV. I hear that term thrown around a lot.
Yeah.
What does it actually mean, and why do lenders care so much about it?
It's simpler than it sounds. It's basically the amount of your loan compared to what the property's worth. So, for example, let's say you're buying a house for $400,000 and you make a down payment of $40,000.
How?
That means your loan would be for $360,000, which would give you an LTV of 90%.
Okay.
So basically, a lower LTV means you've got more of your own skin in the game.
Right.
And for lenders, that's a good thing. It tells them you're less likely to just walk away if the market takes a nosedive.
That makes sense. The more you stand to lose, the less risky you are as a borrower.
Exactly. A lower LTV means less risk for the lender, and they often reward that with a lower interest rate. It's a win-win.
So, larger down payment, lower LTV, potentially lower rate. Got it.
Now, what about these mysterious points I hear whispered about?
Points.
Yeah.
They cause a lot of confusion for home buyers. Basically, they're like prepaid interest.
Okay.
So you can choose to pay this up front at closing, and that can get you a lower interest rate on your loan over the entire life of the loan.
So it's like paying a fee for a discount.
Yeah, you could say that.
Yeah.
Typically, 1 point equals 1% of your total loan amount.
And that can sometimes reduce your interest rate by like 0.125% to 0.25%, sometimes even more. It really just depends on the lender and what's going on in the market.
Okay, so there's some serious math involved here, but I mean, the potential savings are definitely interesting. Is it always a good idea to buy points?
That is the question. And there's no easy answer, unfortunately. You really have to balance those potential interest savings against how much it's going to cost you up front and how long you plan on actually staying in the home. Mm-hmm. If you're only planning on being there a short time, you might not actually save enough in interest to make those points worth it.
So like everything else with mortgages, it comes down to each person's individual situation.
Exactly.
Wow, my brain is officially full.
It's a lot to take in.
We've covered so much ground here. Credit scores, DTIs, all those different types of mortgages, rate locks, down payment strategies, those mysterious points. It's a lot to process. But you know what? I'm actually feeling like strangely empowered. Who knew there were so many things we can actually do to try to save thousands of dollars in this whole process?
I love hearing that. Knowledge really is power, especially when you're trying to navigate something as complex as, getting a mortgage and understanding all those ins and outs. And you're right. There are a lot of things we can actually control. It's easy to get kind of, fixated on the things we can't control. Like, what's the market doing? What are those big economic trends?
Right.
But if we focus on those areas where we can actually make a difference,
yes,
that's how we set ourselves up for success.
It's like that saying, control the controllables, right?
Exactly.
For someone who's maybe just starting out on this whole home buying journey, they're feeling a little lost. What's the one thing you would want them to remember?
I'd say think about your mortgage rate, not as just this number, right? Okay. It's really a tool.
Okay.
It's a powerful tool you can use to build your long-term financial well-being.
I like that.
That lower monthly payment that you're able to secure today because you've done your research, because you've made these strategic decisions, that can have a ripple effect for years.
Oh, yeah.
You suddenly have more cash flow. Maybe you can use that to, beef up your retirement savings, invest it wisely, or even just, honestly, have a little more breathing room in your budget so you can enjoy life a little bit more.
Absolutely. It's about the bigger picture, right?
Exactly. And the best part, even those small things, like we talked about checking your credit report regularly,
right?
Chipping away at your debt, even if it's just a little bit at a time, those small, consistent actions can make a huge difference over time.
I love that. And it really speaks to kind of everything that we've been talking about today. Well, dear listener, as we wrap up this deep dive into the world of mortgage rates, I do want to leave you with a thought-provoking question.
I like it.
Given your financial goals, how much risk you're comfortable with, what the market's doing right now, which of these strategies really speaks to you? What's that one action step, whether it's big or small, that you can take, like today, to move yourself one step closer to that dream of owning a home at a rate you can feel amazing about? Hope for thought. Thanks for joining us on this deep dive into the world of mortgage rates. Until next time.